Hey everybody, Kerry Peabody, your long-term care insurance specialist here. Hope you're doing well. Hey, I'm going to take a few minutes right now and simplify long-term care insurance for you. Long-term care insurance is a hideously complex product. There's a lot of stuff built into these plans that frankly you're never going to encounter, never really going to have to understand. But when you decide it's time to explore long-term care insurance and it's time to design your plan, there are four key parts that really matter. These are the things that are going to control how much and how long your policy will pay benefits, and just as importantly, what the policy will cost. And we all know that's a huge factor. So let's talk about the four key building blocks to a long-term care insurance policy. The first thing we're going to choose when we buy a plan is our benefit amount. This is how much your policy will pay for care every day. This can be anywhere from $50 a day to $400 a day. It's up to you and how much risk you want to transfer to the carrier and how much you want to spend for your policy. So benefit amount is simply how much. Again, anywhere from $50 to $400 a day. The second thing we're going to choose when we buy a policy is a benefit period. This is how long will that policy last. This is usually anywhere from 2 years to unlimited or a lifetime. But this is really important. This is how these two things really work together. Let's say you choose a policy with a $100 a day benefit amount and a 3-year benefit period. If I do the math, $100 a day times 3 years times 365 days, what I've really purchased is a bucket of money of $109,500 that I can use to pay for my long-term care services. Pretty simple. Well, if something really bad happens to me and I go on claim and I use that full $100 a day for care every day, day after day after day, then my bucket of money is going to be empty in 3 years. But most claims don't start in facilities. Most claims start at home where care is usually a lot less expensive. So let's say instead of using $100 a day, you've got somebody coming in a couple hours a day and you're only using $50 a day for care. Well, if I'm only spending $50 a day, I still have the same bucket of money, but now it's going to last twice as long. So just because I choose a 2 or a 3 year benefit period doesn't necessarily mean that my policy would stop paying benefits after I were on claim for 2 or 3 years. What really matters is how quickly you spend the money out of the policy. If I don't use the full amount every day, or if I don't use benefits every day, then my benefit pool is going to be extended longer. So very important to understand that. So benefit amount, how much, benefit period, how long, those two things determine your bucket of money, and that's what really counts. The third thing we're going to choose when we buy long-term care insurance is something that they all call the elimination period. Very foreboding sounding term right there. It sounds like this is the period of time during which the insurance company can have you eliminated so they don't have to pay the claim. That's not what this is. This is just a bad way to say your deductible. The elimination period is the deductible. You get an offender bender with the car, you pay the first $500 out of pocket. With long-term care insurance, it's how many days am I going to pay for my own care before my policy kicks in. That can be anywhere from 0 days to 180 days. Typically, my clients are going to wind up in a 60 or a 90-day elimination period. So when the claim starts, they're going to be on the hook to pay out of pocket for care for the first 2 or 3 months before the policy kicks in. This is really just a price and risk management tool. The longer your elimination period, the more you're on the hook for, the less your policy is going to cost. Pretty straightforward. So benefit amount, benefit period, elimination period, which is your deductible. And the fourth thing we're going to look at is actually optional, but 99% of the policies that I sell and 99% of the policies that every good agent sells is going to have this fourth thing built in. It's going to be an inflation rider. What's an inflation rider mean? Well, let's say that you buy that $100 a day policy when you're 65, but you don't go on claim until you're 85. Well, when you're 85, $100 a day isn't going to buy a lot of care, is it? So we want our benefit, daily benefit amount, and our benefit pool to increase automatically over time to help keep pace with the cost of care. Well, that's what the inflation rider does. Right now, an average inflation rider is 3% compound. So every year, both my benefit pool and my daily benefit amount are going to increase by 3% automatically to help keep pace with the cost of care. Pretty straightforward. Those are the four key parts to any good long-term care policy. Benefit amount, benefit period, elimination period or deductible, and your inflation rider. If you understand those four things, it's going to be a lot easier for you to build a policy that makes sense for you and is going to do what you want it to do when you want it to do it. So there we go. We're done for today. Keep your head down and your spirits up, and we'll talk again soon. Take care.